the Princess
Only
Diana,
cool.
or not Princess Diana, Princess Leia look. Holy cow!
Princess Diana.
My brain is still on London time.
Yeah. Too long. Yeah.
Time to move on, MattyP.
Sadly, time to
Come
move
back
on.
to America.
Back to USA, land of the free and home of Princess Leia.
That's
Wait,
true.
is she from America?
Yeah.
Jeez,
Oh,
I need
yeah.
to stop while I'm ahead.
Yeah, I'm pretty sure she's American.
Right. Did it. All right. What's going on, everybody? We are the HIG Podcast here, coming to you from the Harris Financial Center in Provo, Utah. And I'm MattyP. Good morning or afternoon or evening or whenever you're listening to this. Here with Bronson Kaufusi. What's up, Bronson?
Hey.
How you
what's
doing,
going
man?
on? I'm doing well, thanks.
All right.
Yeah, excited to be here right now.
Nice. Yeah, I'm
Yeah.
excited because we have a special guest again. We want to welcome to the show one more time, Jesse Yeats. What's up, Jesse?
Hello, hello. Great to be here.
Mr. Investor Relations Man, the encyclopedia of investor relations. You know,
I'll take it.
Oh, and more. Yeah.
Cars.
And cars.
Yeah,
Yeah.
Specifically Porsches,
Specifically that.
but
yes.
not limited to.
not limited to, but yeah,
Yes.
that's where my heart is.
So Porsche's number one. What's number two on your list?
Ferrari.
Ferrari. Nice. I see you looking at a picture of a Ferrari
Right
when
now.
you say that. Yeah.
It's meant to be.
Do you know that Ferrari, right? The iconic show or the show that made it? I guess it's iconic anyway.
No, is that Miami Vice?
Close. It was filmed in Hawaii. It's kind of like a detective movie, played by a guy who has probably the best mustache in the world.
Yes.
Tom Selleck,
Yes. What? Name it.
Magnum PI.
Thank you. Oh, I was right. I mean, that's my nose starts with an M.
If you
Magnum
could
PI.
actually, if the picture were closer, you could see the license plate. It says Robin 1.
Oh.
Robin Masters. I don't know. I'm kind of a Magnum PI nerd. When I grew up, when I was a kid, my mom would always watch it. And so I remember watching like this mustached hero driving around in this Ferrari he could barely fit into. And
Yeah.
in the show, like 99% of the scenes with the Ferrari are shot with the roof off because Tom Selleck is so big.
Oh, is that right?
Yeah, his head would hit the roof. If you watch it, his eye line is like the roof.
Oh, no way.
Yeah, he'd barely fit in that car. Yeah,
Make sure he looked good, though. That's what matters.
Yeah, well, with that mustache, you know.
Yeah.
I don't know. I'm trying to support mustaches the best I can because Jen hates them, and I just shaved mine. I was when I made it halfway through our trip, and then I was just like, all right, it's time. Like she's put up with it for a couple weeks. Just gonna shave it off.
Yeah.
So, anyways, we're stoked to be here, Jesse. Thanks for being here again.
Absolutely.
Jesse really is like the encyclopedia of investor relations. I've been working with you for about a year and a half. And any question that I've ever had about investing, I go to Jesse, and without he's always on the spot. It's never a hold on, let me look this up. Hold on, let me make sure I have this term correct. This is what it is. This is what it means. This is how it affects investors. This is how it affects investing, and this is what it means long term. So
Multiple areas too. He's queued up in all different, investment sectors, which is awesome. I had a question just like a couple days ago about, some AI opportunities, and first thought, I'm gonna ask Jesse. Sure enough, he knew all about it. So we're lucky to have Jesse on the team.
Okay. Enough with the sweet talk. You guys are great.
Yeah, well, we're excited for today because this topic is so vital to what we do here at Harris Investment Group, and it's something that I remember being taught this by Jason when I first met him, and it's literally stayed true and guided me in a lot of the decisions I've made as far as investing. And so maybe you could walk us through, what is growth, like investing for growth, and what is investing for income?
Yeah.
And what are they? What are the differences?
Yeah.
Tell us a little bit about that.
Yeah, so growth is often referred to as appreciation, but we'll just use growth as a synonym for appreciation, and then income, right? So the difference is how one chooses to use the cash that's produced by the asset. And so move outside of real estate, for example. Tesla is a growth company. Okay. They don't distribute any dividends. Any cash is produced by the company, they reinvest into the company to further grow the company, right? And produce greater, shareholder value. Opposed to, an AT&T, which they have less ability to innovate and to drive growth through innovating on their products or services. So instead, what they do is they distribute dividends to their shareholders. And so that's the difference. Is how you choose, and the methodology to choose with what you do with the excess cash. And so with real estate, it's the same thing. We can choose to, with the cash flow produced by the properties, to invest it back into the properties and drive more growth, or process distributions that amount to our investor partners. So that's the difference. And so with growth, you're hoping that by reinvesting into the property, you're going to grow its value over, it's going to be worth more afterwards, right? And if you're doing a distribution, what you're effectively saying is, we can't use this dollar to increase the value of the property. So instead, we're going to give it back to the owners, right? Because we can't multiply it. We can't make this dollar worth 1.2, 1.5, $2. We can't make that. We can't multiply it any further, right? And in real estate, generally, what we refer to that as stabilization, where we've done all the work we can, we've grown the property as much as we can, and there's nothing else we can do at this point to further, through our action and our active management, to grow that value. At this point, it's only organic growth. It's what will happen in the market over time, but there's nothing we can do right now in the short term to derive more growth. And so instead of holding on to that cash, we give it back to the owners. And so at that point, it changes from a growth property to an income focused property. That's the new objective. Hopefully I explained that.
Oh, I love that.
That well.
No, that's great. I love how you use the example of taking $1 and, through growth, right? We take that dollar, put it back in, and it turns into $1.2. And then that's what we're doing with the real estate. So if I'm an investor, how do I look at growth and income in a diversified approach when it comes to real estate?
Yeah, good question. Man, this is something I actually run into quite a bit. So a lot of our prospects, people that I'll jump on Zoom and phone calls with, a lot of people have what I call a double standard when it comes to viewing growth and income within real estate specifically as an asset class, that they don't treat against other asset classes. So it's truly a double standard. And this is what I mean by that. A young investor, they've got time on their side before they retire. They wouldn't look at, going back to Tesla, because I know that's considered a growth company. They wouldn't look at Tesla and say, "Oh, they're not distributing dividends? That's not a great company. They're floundering. They're not doing very well. That's probably an unhealthy business. So it's probably not the great place to invest." Similarly, number one, people don't think that way. They understand intuitively, okay, they're reinvesting. This is a growth company. It's not a dividend yielding company, right? But for some reason, when it comes to real estate, it's not viewed the same way. If an apartment building isn't producing that cash flow, or if that cash flow isn't distributed back to them, to the investor, they think, ooh, something's awry here. Yeah. Something's not right. This is an unhealthy asset. It's, there's problems, that I'm not aware of. And instead of, and then, in the background, as asset managers, we're deciding, hey, we're going to take that cash, we're going to reinvest it. But to the novice investor, they're thinking, oh, well, if you're not giving us the cash flow, then that's bad, right? And so where this becomes a problem is, so if I'm talking with a younger investor, where based on simply their age, they should be more allocated to growth investments than income. Yes. They've got so much time on their side. They'd be handicapping themselves if they were to choose to allocate most of their funds to income producing assets opposed to growth. And, they'll tell me, I'll talk to them and try to understand their investment objectives, what they're looking for. And it's so funny when they'll convey that they really want cash flow. it's like, yeah, I want to make sure, I want to get cash flow. Maybe it's because they want to get out of the rat race and they want to replace their wage income with investment income, which I totally understand. That makes sense. But if you're that young, it doesn't really make sense to do that. You'd actually get to where you want to be faster if you focus on growth in the interim, and then over time you rotate your assets into income producing asset or into income from growth. So we kind of have to have this. I carefully kind of guide them through this, talking to them like public equities, like with Tesla, and give them that example and help them realize, actually, based on what they've outlined, if they are a young investor, if they've got time on their side, if they are working, that it actually makes more sense to be investing in growth and not optimizing for cash flow today will actually do them a favor and will ultimately be in their best interest and will allow them to significantly compound their wealth over time so much faster than if they were to start off with just focusing on cash flowing assets opposed to assets that grow.
Yeah.
So is it like an evolution then?
Yes.
Younger the investor, focused on growth. As they evolve through their investment life, their investment cycle over the years, it switches more towards the income.
Yeah, that's exactly right. So if you see this like with choosing your retirement plans, or you're going through a 401k, there's a lot of like target date funds. Say, oh, you're this age, this is your risk tolerance. Based on these qualitative measures, you should be in this fund. And now, this is just me personally. Personally, I feel like they start that evolution, that rotation, a little too soon. Like you could select that you're 25 years old, and they'll still put you in 10% bonds. And personally, I think that's a waste, where that 10%, if invested in growth, would yield higher. You have so much time to make it up if there was the extra volatility that they're trying to shield you from. Yeah. It just doesn't. So personally, I feel like that rotation happens too early. But yes, you're right that the rotation needs to happen. And the closer you get to retirement, the more you want to rotate, because the idea is income means it's an asset that is stabilized and is producing cash that can be given back.
Gotcha.
It's safer. Whereas growth, the asset is withholding the cash. So the investor is not getting the immediate return, so it's less safe. And then oftentimes that growth is also associated with greater volatility. So the value can change. And if you're about to retire within a few years and suddenly you have this huge fluctuation in asset value, it's like, oh no, I need that. That's my nest egg that I just lost, 15, 20% of. And so the general wisdom is you want to rotate over time into income producing assets, safer, more conservative assets as you near retirement age, whatever that age that is.
Yeah, I think one thing that comes to mind is, as I talk to older investors, they're very income focused, like extremely, especially, you have, just have a few more gray hairs and or maybe it's a family office. So you have time as a younger investor, right? That's on your side. But then also, if you're a younger investor and your earning power is increasing, you have these two things that play a role, because you have, if you're a younger individual who maybe comes into a windfall of money, now you might consider, oh, maybe with this windfall, I want more income because I'm going to be building something else. It's every investor's different. It's really
Absolutely.
Interesting. But you have to understand growth and income.
No, totally.
Exactly what we're talking about.
Understanding everyone's specific circumstances is critical here. I mean, we will have people that are super young and income makes sense.
Yeah.
The example you just gave, let's say they have a liquidity event and suddenly like their whole life changes, and their how they view investing changes, where instead of focusing on growth because they want to grow their asset base, now they've reaped the rewards of all their work. And they're saying, gee, now capital preservation is important. And I just don't want to lose with what I made, right? I don't want to lose that value. And so they invest accordingly and they go a lot more safe. And so that makes sense. And that definitely is a circumstance we run into. But educating the principles of time, the difference between growth, income, and then, the other go further left and further right on the spectrum there, between conservative and more speculative investments is important, just so people understand, even outside of what we do with real estate, how they're making their investment decisions and their investment allocations.
Yeah. Well, I love that, you've defined what growth and income are and how important it is, and hope everyone that's listening, really looks at their portfolio and, okay, where's the growth? Where's the income? What's the plan here? And I love, how at Harris Investment Group, we focus on those two areas heavily with multifamily and gas stations. And so, I'd love for you to touch on, gas stations and multifamily here as we're about to close. But I think it's important that, growth and income is a big part of what we do here and the assets that we choose to invest in.
Yeah, is there one side that we tend to focus on more?
Yeah, so our firm portfolio today is pretty much split down the middle, half and half, between multifamily assets and gas stations and truck stops. In addition to those two, the third thing that we lay out as an objective and guide our investors to is depreciation, of course, which is a tax shelter strategy. But yeah, outside of depreciation, it's all about growth and it's all about income, and those two different asset types produce different versions of that return between growth and income. Multifamily, of course, that is all about growth. When at least again, given the strategy and the asset type that we run. So, we're buying 1970s vintages, 1980s vintage. These are properties that need tender loving care. they need
TLC,
need TLC. They need to be renovated. They need to be updated. And it's because they're more distressed state that we have that, what we call meat on the bone. There's an opportunity for growth for us to come in and meaningfully increase the value of the asset after dumping in a bunch of cash. Right. And so that is 100% a growth play, within the short term. But what that means is for investors who, within the first couple of years, they're not seeing income. They're not seeing cash flow produced because, again, not only are we not sending it back to them, oftentimes there's periods where there's not cash flow, right? Because we're driving vacancy and there isn't cash flow to be distributed, right?
Yeah.
So in the first couple of years, it's all about getting the asset into a position where we can realize the value of the growth that we've put into it. And so those assets are definitely more geared towards growth as the objective. Conversely, gas stations and truck stops, because they are absolute triple net lease, we benefit right out of the gate after we acquire the property from the monthly lease payments that are paid to us from our operating partners. And so it's totally different, right? Right out of the gate, we're making cash flow from that asset.
Yeah.
And the nice thing about truck stops lease today, and I think this has been discussed with other people that have come on to the podcast, just because of the market dynamics and the current opportunity, they're also provide really great growth opportunities. So there's within the investment space, there's a lot of assets that are called growth and income. They're both. They provide both. And today, gas stations and truck stops definitely fit that bill. They're a growth and income play because we're able, through the different conversion strategies that we run with our operating partners, we're able to drive a lot of growth as well. Yeah. So we got income out of the gate. There's also a growth opportunity that we can derive after a few years of ownership, and so together they're extremely complementary. When you have a portfolio with both asset types together, you have some assets like multifamily, which aren't producing any income. And then you've got, meaningful growth on the back end. And then you've got gas stations and truck stops, which provide that income on the front end. And then as well as other growth on the back end. And so together, they can work kind of hand in hand in achieving both investment objectives.
Yeah, man, that's incredible. Yeah. I appreciate you coming on today just because this is a vital topic to what we do and just an overall investment strategy for a lot of our investors.
Yeah, I think people just need to look at their own. It's helpful to look at your own portfolio and just assess how your money's working for you.
Say someone wants to look at their portfolio and they want to look at it with the more growth versus income objective, and they have some questions. What's the best thing they can do? Like, if someone has a question for you, or if someone wants to talk to someone here. Harris Investment?
Yeah, I mean, of course, we're an unbiased source there, especially when it comes to other parts of your portfolio. We have strong opinions when it comes to real estate, no question. Many of us on the team have wealth management experience and have broader experience within other asset classes. We love holding portfolio reviews as just a way of adding extra value and providing an unbiased source of where we think things are at. Because people will come to us, and these are generally investor partners, and they will ask us to analyze their other parts of their portfolio. And yeah, it is insightful because we'll uncover areas that are underutilized. Again, just using the easy example of a young guy in his 30s, and as we kind of go through his portfolio and how his money's allocated, he learns that a lot of his money is tied up in investments that are again not geared to the right objectives. Less growth than probably what he should be given, what his actual objectives are. Mm-hmm. It's fun to have these conversations and to have them articulate what their objectives are. They say it, and then we go look at their portfolio and it doesn't match what they said.
Mm-hmm. Yeah, that's valuable though.
Yeah, and it absolutely is. And again, we're talking outside of real estate as well. I mean, that most of the folks that we talk to, the majority of their capital is in other asset classes.
Right.
So, traditional assets like stocks and bonds, primarily. But anyway, assessing how your money is working for you, I think is critical because it's a long game. And if it's kind of like the analogy with like airplanes, where if you're just like 1 degree off, then over a flight, like you'll end up hundreds of miles off course. Right. Yeah. And the same thing goes here where not that you would be off course with your money's still going to work for you, but it's definitely impactful the same way in terms of how much your money can grow. And ultimately that's what we're trying to do, right? Yeah. As everyone nears retirement, we're trying to grow that nest egg as big as possible. So eventually it can produce a yield for us on that total value. Yeah. And so that way we can sit back, go on the beach with a pina colada, and we can clip that coupon, that yield from our portfolio. So we want to get it to grow as much as possible so that yield can be as high as possible. So making sure your money's working for you in the best way to get you to that objective is really important.
Oh, go get the pina coladas. Yeah. Get straight to the pina coladas.
Exactly.
Oh yeah. Well, this is great, man. Thank you. And if you have questions though, be sure to email us at contact@harrisinvestmentgroup.com. We love taking questions. If you have questions for Jesse, just put his name right there in the email on the title or the subject, and we'll make sure we get those questions answered.
Jump right on that.
Thanks for being here, Jesse.
Absolutely.
It's always nice chatting with you. It's always nice picking your brain.
Cool. Thanks, guys.
Yeah, this has been awesome. Thanks, Bronson.
Till next week.
Hope you find your dad.
I will. See you guys.